Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest edition of the Market Misbehavior podcast. It's so much fun through the structure of this podcast to sit down with top market practitioners, investors, traders, strategists, analysts, money managers, authors, educators, anyone else we can sit down with to pick their brains a bit, try to learn some of their lessons learned over the years, see through their eyes a bit in terms of what stands out as they are reflecting on the current market environment, try to dig into their processes and routines and wisdom as much as we can in a short podcast conversation. The podcast so far, we're just over 20 episodes in, and it's been a real pleasure to sit down with some authors, some of which I'd known, some of which I met for the first time. You know, I love being able to expand our understanding of different approaches, different strategies, different markets of which you may be less familiar. And I hope through these conversations it just spurs you to dig a little deeper and to go through some of the efforts of your own to learn more about these practitioners, learn more about what they are presenting, and develop your own thesis about how you are viewing the current market environment. Today, I'm sitting down with someone I consider an old friend, Jeff Hirsch, the editor of the Stock Traders Almanac. I met Jeff years ago. I won a guest through the CMT Association, probably through an event of some sort. But I've subscribed and have owned the Stock Traders Almanac for longer than I can remember. I love having it nearby as I'm looking at the markets. Because while it might not necessarily match exactly what is happening on any given day, it gives you a framework. It gives you a starting point with which I think you can assess the overall market conditions. What Jeff is doing at the Stock Traders Almanac here in 2025 is continuing the efforts of his father, the legendary Yale Hirsch. Unfortunately, no longer with us, but Yale really, a lot of the things that we take for granted, things like the Santa Claus rally, the January effect, sell in May and go away. You know, while he didn't invent those necessarily, he certainly popularized them. And the fact that those sorts of ideas are sort of part of the modern vernacular of traders on Wall Street is a credit to Yale Hirsch and his foundational work of promoting the concept of seasonality and seasonal trends and tendencies. So sitting down with Jeff, last week, this was sort of late January of 2025, we talked about what a post-election year normally looks like. And that's kind of where I found the Stock Traders Almanac and Jeff's work to be so helpful. What usually happens at this kind of general place in the cycle, what usually happens at this point in the normal 4-year cycle that we observe with the election seasons, and what normally happens the year after an election. What happens in Q1 is the volatility that we've experienced so far, certainly the emotional volatility, is that normal for this time of the year? We talked about how the Santa Claus rally really didn't play out, but we also talked about what he calls the January Trifecta, 3 different indicators that you evaluate through the month of January that have a pretty good predictive value about what the rest of the year could hold. We talked about how seasonality has changed over time and how some of the things that, 30, 40 years ago made sense may not make as much sense. We focused on sort of the newest, latest and greatest ideas that I think investors should know. We talked about how to use indicators like MACD, which is something that Jeff uses to validate some of the seasonal tendencies through the normal pace of the year. We talked about positioning small caps and their seasonality. Talk about seasonality for cryptocurrencies, particularly Bitcoin, because Jeff's done some of the first work that I've seen on seasonality in that space. And overall, it was a fantastic discussion about what we're observing now in the markets, how that relates to the normal seasonal patterns, and what sort of playbook we should have in mind for the first half of 2025. So please enjoy my recent conversation with Jeff Hirsch, editor of the Stock Traders Almanac. So super excited to sit down once again with Jeff Hirsch. Jeff's the editor of the Stock Traders Almanac. Has done such a fantastic job continuing, I think, the legacy of his father, Yale Hirsch, who really, I feel like, set the stage for seasonality. And Jeff, you've done such a fantastic job sort of continuing that legacy, doing great work. So thanks for sitting down with me. Good to see you again.
Good to see you. Thanks for having me. And thanks to Yale for making this all possible for us.
Credit to him for sort of recognizing the value of seasonality. Great credit to you for keeping things going and I think evolving things in such wonderful ways, adding money management capabilities, all the other things you've done. I think congrats on your success as always, Jeff. I think of you as sort of the expert on seasonal tendencies, on helping us recognize what has tended to happen so that we have a framework with which to consider the current environment. As we kick off January here in a post-election year, What's the normal setup? How should things normally play out? What would we expect this time of year?
I mean, this volatility is not unexpected. First quarter post-election years is one of the weaker spots of the 4-year cycle. January's been experiencing some profit taking over the years. It's kind of knocked off its high horse of being, one of the top months. It's had some rough patches. So this vol, this chop is kind of standard. I mean, you look at the seasonal chart I throw up there, January performance with, the recent 21-year period shows kind of choppy flat in the beginning, and then, a little bit weaker at the end, but post-election years a bit stronger at the end. We get through that period between election and inauguration with the world not falling apart. The market's kind of okay with that. We get a positive inflation number, and January barometer's back into black,
I was going to say, so I mean, there are a lot of obviously seasonal tendencies that we've heard about, and that I know a lot of people like to follow: the Santa Claus rally, the January effect, all of these things. Start us with December into January. The Santa Claus rally really didn't materialize. Does that concern you? I mean, is that a negative sign, or is that overcome by other things that you're seeing?
First of all, credit where credit is due. My father invented the Santa Claus rally in 1972, along with the January barometer, which are both based upon the S&P. January barometer is the full month S&P. As the S&P goes in January, so goes the year. Santa Claus rally is the last 5 trading days of the year, first 2 of the new year. And this is based upon, I've heard some people try to say, is it the open or what? It's the closing price on the given days, that you're talking about. So January barometer is the closing price of the S&P in December, the closing price in January. And you have what we did. We stood on Yale's shoulders. There's an old first 5 days of the year early warning system. We took all 3 of those. That was something from the old days. It's not the first week. It's the first 5 trading days. So the 3 of them, the January indicator trifecta, we built that back in 23 based upon Santa Claus, first 5 days, and a full month barometer. When all 3 are positive, you have the year up 28 of 32 years, 90.6% of the time, for an average S&P gain of 17.7%. So the January trifecta, everyone got concerned that Santa Claus failed to call. But as Yale, wrote years ago, if Santa Claus should fail to call, bears may come to Broad and Wall. There you are. I thought I lost you. My heart be still.
We're good. We're good.
But it's really all about the January barometer.
Yeah.
Years when you have Santa Claus down, the first 5 days up, January barometer's up, you have solid gains, and seeing the market turn like we did after the 5% correction or so is encouraging. Right off. I mean, here we get into your chart for the technicals. The election gap, between the election day and the day after is kind of where we found support. Pretty much right in there. There it is. Big gap. We know the market likes to fill those or close those. Along some of the other support lines, you've got some of my favorite support levels there. I like that the lines there are thick. They're not fine, perfect to the decimal point there. So January barometer is when I, wait to get the full month barometer before I make any adjustments to my forecast or outlook. So far, what we put out at the end of the year based upon the new post-election year patterns, which post-election years are a lot better than they used to be. We're looking at a base case scenario of like 8 to 12% for 2025 with some weakness in Q1, perhaps Q3. We'll see what comes out of this new administration and how the market reacts to that.
It's interesting because I think you mentioned, Jeff, just now that it used to be not as strong. And that's what I remember reading, years ago, kind of reading as much as I could about seasonality and sort of the, election year, a lot of optimism going into a new president. And then the year after is sort of like the hangover year where things sort of, it takes some time, but it's gotten better, right? I mean, in recent history, post-election years have actually been stronger, right?
It's the best year of the 4-year cycle since 85. Up 8, down 2. I mean, the pre-election years up 9, down 1. A little better gains for the post-election year, 17% versus 15. But it's kind of, how the third year is like the prime of the pump year for the election year. Everyone, you got to get stuff in place so that voters are real happy by the time election year comes around. Well, it's kind of like a double pre-election year. It's sort of ahead of the midterms because the midterms have become a little bit more contentious and they're trying to just, hang on to the slim margins they have or increase them. So you've seen a little more priming of the pump in the post-election year in recent years. But it wasn't that great up until 85. You can just look at some of the recent years where, it's just been some big numbers in those post-election years versus going back to 1917, 37, 57, 69, 73, some rough post-election years.
So, thinking about how the market has started off in a position of strength, I mean, you sort of choppy beginning to January, but now all of a sudden, in the last week or two, we've seen an upside resurgent here as Trump has taken office and starting to see some initial policy decisions. But from a technical perspective, hard to deny the fact that the prices are now sort of, going back on offense. If, the beginning of a post-election year can be choppy, but then usually improves right through the course of the year, what would you be looking for between now and later to, sort of recognize that the music has stopped? And I guess another way to ask of it, market looks strong here. What would you be looking for to say, okay, this uptrend is now in question? Is it a seasonal question? Is it a trend question? And what kind of things would you be looking for there?
I think it's a tracking question from some of the different, seasonal patterns that I've mapped out. I don't know. Did we get you a copy of the 25 book yet? Did you get one?
I have one. Yeah.
Yeah. If you look on page 11, if you don't have it handy, you'll see the chart of post-election years. And then there's the one at the bottom. I'm just going to flip myself because I always keep my book handy here. It's the incumbent losses years. If we start to track that, I'll get a little bit concerned. The sort of red line going down there at the bottom there. That's the one that we want to worry about. And I've already plotted the current year to it. We had that little dip that I mentioned, which we bounced off of. I think the other thing that was encouraging with the technical bounce that we both saw there at that the gap is also the sentiment numbers. I track the Investors Intelligence, newsletter writers, bullish and bearish advisors, and that didn't get as negative as you see at a bear market bottom, but it definitely flipped, and a lot of people went bearish, a lot of people went correction, and it really coincided well with the drop and the turn there. So the thing that I'm looking at, aside from events that may happen, is how the market in 2025 tracks those cycles that I map out in my outlook in the 25 Almanac. If we start to dip lower in this first quarter, into the negative area, I'm going to start to get concerned.
It's one of the things I love about the Stock Traders Almanac, and I've gotten it more years than I can remember, Jeff. And every time, what I love is through the course of the year, you kind of see how things are playing out. You can look back to sort of those tendencies and just think, is this something that is kind of normal for this period, or is this something unusual?
Right.
One of the things that I always love as we get sort of into the spring, then into the summer, you often talk about a MACD sell signal that often is combined there. Can you talk a little bit about that and how that relates to sort of a normal seasonal pattern through the year?
Well, we use MACD timing to time better entries and exits in and out of the best and worst months of the year. We had our buy signal in October. We start to look for an 817.9 crossover for those of you that know the indicator well. And we do that in the last month of the worst 6 months or the worst 4 months for NASDAQ, so that we can catch that turn. We know October, it's history, October phobia. It's a bargain month. I mean, I should flash you a picture from the 69 Almanac where Yale's talking about the bear killer and the bargain month and the best time to buy stocks, back when I was like 2 years old, 3 years old. So it still works. And then we look for a sell signal using the slower, a longer MACD, the more standard one that people look at, the 1226.9. For S&P and Dow, it's in April, the last of the best 6 months. For NASDAQ and Russell, it's the last of the best 8 months. In June, we start looking for a new crossover. Not something that already exists, but you want it to cross over. And it's better if it's either above the zero line for the sell or below for the buy. And I know you probably know this, but the thing with MACD is it's not something that was designed to be used in a vacuum. Just looking for MACD triggers. You get a lot of signals that aren't they'll get you whipsawed. You want to look. You want to use it to confirm another reason to buy or sell a stock. In this case, for the seasonal pattern, it's seasonality. It could be relative strength. It could be fundamentals. I mean, we look at the 5 disciplines, seasonality, fundamentals, which includes stock, corporate and economic, technicals, your specialty, and sentiment, as I mentioned, and monetary policy, which has been a little bit murky recently. I think we got a little clarity after the PPI and CPI, at least the fears of the Fed hiking because of rampant inflation or sticky or persistent inflation have been alleviated somewhat. And we track that with the 10-year, and we saw the 10-year as it came through. We had a line in the sand about 4.3, but as it came through 4.5% and really went up there, that put pressure on the market. And I think the dollar is also a good thing to look at as it tracks the 10-year as well. So a little dollar weakness helps support. Look at you. God, I could use a lesson in stock charts.
I got you. So this is the dollar
private tutorial.
10-year yield, and this is the dollar index.
Yeah. So you see the dollar coming down there, and since mid-January, right? Same with the 10-year. Stocks go up. So these are some of the things in addition to, as you asked me earlier about what I'm looking, what will have you run for the hills. Yeah, we'll track the 10-year and a dollar along with the seasonal pattern, and those should give us a good look at what the market's going to do.
Given this sort of structure where we have stocks again generally, improving at the beginning of the year, we've certainly seen some choppiness with the Magnificent Seven kind of rotating away. You saw some value sectors like financials start to surge higher, but now again this week, we're recording this January 23rd. Sort of the alphabets, others are sort of rallying higher. Given the optimism that's reflected in the charts of the S&P and the Nasdaq, how you position yourself in this sort of environment? Is it back to sort of the technology communication trade that's been so successful? Is it back to large cap growth, or are you seeing opportunities elsewhere for some reason that investors should be thinking about?
It's broadening. I mean, we're still in the large cap. I own the Qs, I own the SPYs, I own the IWMs. Not as doing as well. There's this January effect we didn't really talk about, the small caps, but we're also seeing some chop in our stock pick. We run a fundamental screen, annually when we get our buy signal for MACD and the best months. And I've seen a lot of volatility in those stocks as well. One of them just popped today, OSI Systems. It's a security. I think it's, news of what's going on at the border. I think that was up 13 or 14% this morning. So we're seeing opportunities. And what we look for there are stocks that are exhibiting an acceleration of growth in earnings and revenue sequentially and year over year, as well as good valuations, a mild relative strength, good technical chart, sort of humming along with the market, not really, and also underfollowed by Wall Street analysts. And we've seen some, some chop there, some big winners, some not so, some couple losers, that we get stopped out of, but that's the way it goes in this business. So I'm seeing some opportunities in security and AI related and energy as well. Sure. We've got a seasonal trade in copper and energy, like the XLE and XES. I own the XES as well as the copper miners, the COPX. We also put out a recommendation to subscribers on CPER, the copper ETF. There's a seasonal trade from like December to May there. So, there's a lot of opportunities. And for us, being the seasonality people, there's always something coming around the calendar for us to look at. So aside from the macro trends with Trump 2.0 and AI and Stargate, there's also the general seasonal things. And as we talked about before, the thing that you look at is the current trend of any particular sector or seasonal pattern tracking the history? Is it setting up with history? If it's not, we'll take a pass at it. Natural gas is coming around on the calendar as well. In February, we're looking at, if that's tracking well, if it sets up nicely. I know there's been a bit of a run there. So we're always looking at, was it Patrick Henry that said it? I know of no way to look to predict the future by drawing a line from the past through the present. So
I love it. I love it.
One of his lesser known quotes.
Yes,
from,
right. Why not though? Hey,
it's in the Almanac.
Yeah, right. You mentioned small caps, and I feel like for much of 2024, and I'm guilty of this as well. It's sort of like announcing the return of small caps. There are all these sort of false starts where it felt like, okay, this is the time when small caps start to exert some leadership. Every one of those times, it felt like it kind of came back, and here we're the Russell 2000 again, kind of lagging with some notable, exceptions to that. But generally, we really haven't seen the resurgence in small caps. Is there a time based on your work where that looks like a likely scenario here going forward, or what would tell you that that's what's to come?
Seasonally, it was supposed to have happened already.
Yeah.
The January effect, which is small caps outperforming large caps in the month of January, going way back to Sidney Wachtel's research in the 40s from, I don't know, he was some investment banker, but we've seen that effect happen mostly the last couple of weeks of December, and a lot of it begins at the end of October. Didn't happen. It's starting to turn a little bit now. Just looking at the Russell 2000 versus the 1000, again, not as convincing as I'd like. And I can see it in some of the small stocks that we've picked in our portfolio as well. Rates and inflation and stuff going on in the economy are giving the small caps a little bit of trouble. There are select ones that do well, and you have to be a stock picker in there. So as I said, I own the IWMs for the seasonal trade. Gave back a bunch of the early gains, but we'll hang on to that until we get through the seasonal period. So it'd be nice to see the Russell 2000 make a new all-time high for the first time since early November of 2021.
Yeah.
Intraday it did, but not closing.
And obviously, I mean, with small cap, and one of the things we've talked about a lot on our with our content is, it's such a sector bet too, right? I mean, the mega cap or the mega cap growth stocks dominate the S&P, the NASDAQ. The small cap small cap indexes have a very different sort of sector weighting, and it's not as growthy. It's a lot more value tilted. And growth has continued to sort of dominate. I'd love to rotate here, Jeff, talking about cryptocurrencies. I know you and Adrian Zadunchik, who we both know.
Yeah, good man.
Really, really good guy. And you guys did some interesting work, sort of early work, I feel like, on seasonality. Now we've got some years, we got some data to deal with. What have you learned about the seasonal tendencies of Bitcoin? Bitcoin now nearing all-time highs once again. What sort of outlook do you have for there? And what sort of bets do you make in this environment?
It kind of tracks the stock market seasonality, maybe a little bit ahead of it, like kind of bottoms in September, but it tends to have sort of a 4x relationship to the NASDAQ. I don't love, weird wallets and coin trading accounts. I'm a stock guy. I'm an ETF guy. So I buy the ETFs. When Adrian and I put out that first report, the seasonality of Bitcoin back in September of 2023, we timed it to come out at the sort of annual seasonal low, sort of for fun, and because it was, made sense. I bought the GBTC, the grayscale Bitcoin ETF. I think I made about 90% on that trade, sold it out in January, missed a little bit, of the final run up there into the spring before the halving. Yeah. And this time around, we were trying to get it on a dip back in September, October, using the iBit. The iShares is the one IBIT, because it's a lower fees now, and it's got most of the liquidity and volume of the Bitcoin ETFs these days. Sure. I own that now. I bought it at about 40 and 15 or something like that. And we didn't get our buying a dip. We probably should have gotten that early September dip. It sort of bottomed a little bit earlier. It never came back down there. And then looking at the seasonal charts, November having a huge average performance over all the different time frames that I've analyzed. I just backed into it. We got to get in there before November, and it turns out to be a good move. Is that the seasonal pattern below, or is that?
No, just momentum. Just looking at
momentum.
RSI.
So I did a bar chart of the seasonal performance averages and November shoes. So we got in and we put that in the newsletter as well, the IBIT, and it's working out, and I think it's going to run into the spring along with the best months. Probably get further new highs. I know Adrian's getting a little concerned about the future of Bitcoin, and he's the burb, he's the crypto guru. He knows what's going on deeper in there. And the fact that it's maturing, it may not be the big spec trade going forward. It may end up falling back into a more typical seasonality trade with the stock market like we do.
Yeah, I love the work that you guys put out, and since that time, a September low, strong November has played out pretty well. It's certainly what happened last year, so I appreciate that you did that. Talk to me a little bit. I mean, Jeff, this is awesome as always. I appreciate sort of setting the table for 2025, giving us some things to think about. Where can we point people to learn more about you and your work? Stock Traders Almanac, I'd highly recommend, and we'll put a link in the description so people can check that out. It's something that I think people should have on their desk. Where else can we point people to learn more about you and your work?
I mean, you could put me into search, Stock Traders Almanac, whatever your favorite search engine is, it'll come right up. Just go to stocktradersalmanac.com. Almanac Trader, as you can see there, is the feed. And you'll find a blog there. And with the newsletter, we put out recommendations on stocks and ETFs with actual buy limits and stop losses and entry points and exit points, and not just buy this stock, but when, at what price, and where to sell. Same thing with the ETFs. We do a monthly analysis of the month ahead with all the seasonalities, and I do an outlook talking about like the 10-year type of stuff that and the 5 disciplines that we mentioned. And everyone gets a free copy of the Almanac with the newsletter. So, check it out, stocktradersalmanac.com.
That's fantastic. And again, you're active on social media at Almanac Trader on X, and I appreciate what you put out and what you share with the community. Jeff, great to see you again. Thanks as always. I appreciate it. We'll hope to check in with you later this year. Sure. Maybe as we get to some of those seasonally weaker parts of the year, we'll see how things have played out. But good to see you today, and have a great beginning of the year, right?
Good to see you. Look forward to it.
So there you go. What a fun conversation. Again, what I love about Jeff, I mean, he manages money and analyzes the markets, but it's, usually through the lens. A lot of his work is through the lens of seasonality. And I feel like seasonal trends are things a lot of people kind of casually look at, right? They're usually aware of sell in May. Like when it gets to May, I'm usually thinking, all right, sell in May, go away. When it gets to September, October, that's often when markets bottom, but Jeff has taken it to a much deeper level, and the capabilities that they have at the Stock Traders Almanac are pretty fantastic for, I feel like, illuminating those normal seasonal tendencies, and then that helps you understand when a particular move in the market on any given week, any given month is sort of the normal thing that happens at this time in the cycle, or if it's something unusual. And I find that that's a really good data point to keep in mind as you're figuring out how to position yourself through a period of market instability or market uncertainty. As I mentioned, there's a link in the description for Jeff's book, The Stock Traders Almanac. It's released every year. You usually can pick it up at the toward the end of the previous year for the year to come. I would strongly recommend checking it out. Even though we're a month in, there's a lot of year left and a lot of Almanac insights. Also quotes every day, which I love. I'm a sucker for financial quotes, and some of my favorite quotes about investing have come from random days in the Stock Traders Almanac. Also want to let you know, if what I talked about with Jeff, if what we went through in terms of analyzing the market conditions, about the return of small caps, how Bitcoin is actually playing out, the S&P and the NASDAQ, and navigating potential movements, if you want to learn more about those tools and techniques that we talked about, our Market Misbehavior premium memberships could be the perfect way to help upgrade your decision making, improve your market analysis routines, and help you find more consistent processes and ideally consistent returns. 3 benefits I think you'll find from the Market Misbehavior premium membership, and you go to marketmisbehavior.com/premium for all the details. But here are three things that stand out. Number 1, virtual courses. So we'll teach you technical analysis, behavioral finance, what's happening inside your head, why it's tough to make good decisions with your portfolio. Sometimes it's not your fault. It's how you're wired as a human being, and it for a good reason, but it doesn't really help our investing process. But we'll talk about how technical analysis is a practical toolkit, a set of tools to help you minimize the impact of those behavioral biases and hopefully make better, more consistent decisions with your investment portfolio. Second thing, a bunch of premium members-only reports. Our weekly flight plan is our main report that we put out every weekend. That's a look back at the the week that just occurred, what happened, what did we learn, what was new, what was different, and we look forward at the week to come. What signals, patterns, movements are we on the look for, and it hopefully gives you a good sense of things to pay attention to through the course of the next week. Also, our monthly chart review, where we apply our proprietary market trend model to a bunch of different asset classes and different ETFs. Finally, an active members-only community, a supportive space to learn about mindful investing and ask any question that comes up. I'm in there every day answering questions from our premium members. You may find some of my other premium members that have been with me for a while may weigh in with some of their insights as well, and I found that a very interesting and compelling part of our growing Market Misbehavior premium member community. So won't you consider joining us? Give you a great gift to yourself, more mindful investing in 2025. For more details and all the info, go to marketmisbehavior.com/premium. Make sure you use the code podcast when you check out for a special deal on your first 12 months on any plan. That's it for today. Thanks so much for joining me here today on the Market Misbehavior podcast. Hope you enjoyed this conversation with Jeff Hirsch. Would love to know if there are others that we should sit down with. If you go through our episodes, you can see the people that we've connected with. Very excited to sit down with anyone that'll sit down with us, and we are happy to approach any of those people that you think would be worth hearing from. So let us know. Drop a comment and let us know who we should approach, and we're happy to do so. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.